Alright, family. So basically, this is the financial statement for Fontana. Yes, been a couple of minutes, but it there. Alright, so where to even where to even start? Alright, so as you can see from just the statements, like revenue has been growing incrementally for the last 5 years. Yeah, been growing and growing and growing and growing, which is a good side. Also, the net profit, like after all expense and everything, still continuously has been growing. So yeah, this financial statement is from, I think I just did it from 2019 because that was the day that they came on the Jamaica Stock Exchange, and it'll be a 5 year trajectory basically to see how they have been performing. I think at the end of this tenure they're going to start getting some taxes, I guess. They're going to be getting some taxes, but we'll see how those financials look when the 2024 metrics come out. Additionally, over like the years, they have been significantly increasing their assets as well, like both fixed and current asset. But the total asset overall has been increasing over the years. Like it's not really stagnant because they've been buying new places, and having different departments are well, different locations, store locations. All right, but let's get to the other stuff. The financials, you can really look on that itself. The financial statement, I'm here to really share like what is not being shown. So the ratios. So these are how the ratios are. These are the ratios for the 5 year tenure. No, by 5 year tenure. So you have liquidity ratio, efficiency ratio, profitability ratio, and leverage ratio. Current ratio you want it within like the 1 to 1, means your current assets can cover it, and you want quick ratios to be at least 1. And as you can see, in 2019 it wasn't so hot, but since then it has been maintaining that. Means if them sell everything except inventory, which I don't think might be a problem because it's one of the stuff that they sell are like fast-paced items, they'll be able to cover it. And their ratio as it stands right now for like current ratio is high. So they have roughly 2.5 times what they need, like to cover all of their liabilities, which is good. Turnover ratio now, just how fast inventory turnover basically, I think per year. So this would be 4 times on average, roughly, as you can see, per year. Average collection period is wild, but this is like roughly 6 to 9 times a day. And I think I'll explain that better when we go to the cash conversion ratio, the cash conversion cycle. Sorry. Number of days in inventory tied up, 88 days. So that means, let's say roughly, um, 360 divided by 80. So roughly, basically, 4 times, which they have maintained. So basically, every quarter, them like restock back on all them inventory. Gross profit margin and net profit margin, evidently, this is a third for gross profit, but when it go down, when you like all the expenses are roughly like about 10% of them revenue end up as net profit when you check it out. Debt to equity ratio is like it good. You can see that they don't really have anything significant as relates to debt compared to what they have. So it is good. And 1 to 1 roughly is good. Is good. And interest cover ratio mean the interest of their debt, much time you can cover it um as stand. Yeah, you can do 20 times, etc. 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 So the RF ratio, you want zoom up a little bit if you want like stop and probably look back on it. Alright, so yeah. So DuPont analysis that everybody knows is interesting. Is interesting. As I was saying, that the margins are like roughly 10%. Granted, 2020 was rough, But roughly 10% of revenue is really margin. You can see return on asset has been pretty decent. Like everything is relatively stable. And what I found interesting is the fact that they have been increasing, I think maybe over the last 2 years or so. They've increased the Portmore location. I think the Waterloo location was one as well. Um Yeah, but they've still maintained most of their margin. So when you have an analytical team is like good because normally the big get margins probably get smaller or things start cost more, so it eat out their bottom line. But they have been pretty consistent with their revenue. So that means that when they do the analysis of a prospective location, they're running their models with the aim in mind of about 10%, which is good. So if they move a new location, so one location I sell 10 million and I want to sell 100 million, they're still maintaining that 10% margin, which is good. And the fact that they since 2020 their leverage hasn't been drastically changed is also a good indication of, even though it is a junior market company, it is very very stable. So yeah, and you see in the charts it literally boring, so you don't even, you can't necessarily choose a specific driver. They've just been making efficient moves right across the board. And yeah, granted, it kind of sucks because you want to see our revenues going up or leverage are going drastically down. But the truth is, they don't really have much leverage. The return on equity has been stagnant for the most part. So there is that. It has been stagnant. So at least you can predict where you'll get. And yeah, there's no like real main driver. They've just been hitting all bases right through and through. So yeah. So granted they did make a big jump for leverage, but then trickle out, and then with the return on assets, because they have more assets now, so the percentage shrunk a little bit, and it's just been consistent for the last couple of years. Well, so yeah, Almond Z score now is normally used in companies that like manufacturing and them something there. You want Almond Z score of over 3 for me say yo for like for the near future, maybe a couple years or so down the line, the company is safe. And believe I've spoken about Almond Z score, but normally all my calculations I'm show you how to get it so you can go back with it yourself and figure it out. Remember, no, this is advice, just a YouTuber. Yeah. So basically, as you can see in 2019, when they probably check, they were at 13, which is really really good. Means because, and the reason why I did even Almond is because look at all this solar stuff. You see me? And I just this solar stuff. You see me? So yeah, and then basically almost like a distributor thing. The Almond Z score, as long as it's over 3, you could. Alright? They say 13 and it drastically dropped to 6, which means remember they added like two big locations. So then they're probably working, probably still not start working fully yet. And as it stands right now, it's still 5, which is over 3. If next year come and you see it start drop, then you can start worry. But for now, we see we want at least something for like 5.4 for sure. So alright on a decline. Say. But Alman's score going get smaller as the company gets bigger. So there is that. So he was talking about cash conversion cycle when we talk about the turnover ratio. Here is very consistent, and one of the things about maths is maths going to keep maths in, because yeah, try to find what this is saying. So cash conversion cycle, which is I learned this in college. DIO plus DSO minus DPO, which is days inventory outstanding plus days sales outstanding minus days payable outstanding. So days inventory outstanding meaning say how long you have inventory, how long it take to sell the inventory, how long it take to get paid for the inventory. And with Fontana, so the calculation here. So average inventory, you can read this for yourself here and do it over. So yeah, I think although for kinda yeah confusing less, we carry down to two decimal places. Well, three. But yeah, there was figures here, so that's why there's figures here. So, but just to carry down so you can like see it with less confusion. So basically, when the calculation as I say is DIO plus DSO minus DPO. So plus plus then minus, and you get the results. The results, this means, alright, so you want a cash conversion cycle as low as possible. Alright, as low as possible. You want it. And the way how low for them be in negative. So this means that the inventory that they sell, the manufacturer that they buy it to, they start selling those inventories before they actually pay. They start selling those inventories before they actually start paying the suppliers basically. And then after them sell off all the inventory or whatever, them collect it. And normally it's not really say even after them sell out everything, but they have like a period. I think normally is like 3 months. Because when you look on a manufacturing company, you see these numbers are positive. So yeah. So that means this 1/17 means they're paying it long. So this is about roughly when you check the days, or well you can do it in years as well. It mean like every quarter. So roughly they'll get the goods and then they'll sell it back in quarters. They'll pay back every quarter. Say so that is what this really is. Say every quarter they'll pay back. So this is not really days, it's like years. But yeah. So 1/17, and then they took longer to pay them back, mean like they had a bigger grace period. But because it is expected, seeing that they increased their assets, more stores, on this and that, they can not only sell things faster, because yeah, even though it's long, normally, manufacturing companies would give them a grace period for them to sell everything, but they're getting bigger and bigger and they're selling more and more stuff. So each year it gradually increases. Means they are benefiting from selling off things exponentially faster. So it's a nice position to have the goods, sell the goods, and then pay who you buy the goods from. So yeah, and typically that's like it's especially pharmaceuticals. Like normally they'll ship it here and then extra you have contract with different um companies. So yeah, different pharmaceutical companies. Say so now let me see what we have. Now we're going to go to the metrics. Alright, so metrics really, as I was just looking at this stuff and just comparing certain stuff. So profit before tax, as I've been seeing when I was saying that they have been maintaining their margins through and through, it actually shows in their metrics because profit before and profit after tax. Like as you can see, granted in 2020 they made a big jump. I think they added other locations. Then you can see it's been normally the same trajectory. So even though, so I'm expecting at least the next year to be about the same. And I did it for 2019 because, well, it's January 2019, they got listed on the stock market. So we should see this shrink a little bit though, because they're going to get the tax benefit same way for the 10 years. Because 5 years they get, I think, 100%, and then after the that 5 years, you get another 5 years at 50%. It should shrink, but I'm saying we just have to wait and see. Yeah, so that was that. Their sales over here, so Also, guys, a math me I use, I record this video because flow negative more internet. So there's that. So the sales, so if it look like it's stuck in or glittering or glitching, yeah, at the look phone that spot. So sales now has been increasing. This is I'm tell you they have been just consistent. This is like a generic chart. Yeah, they have been consistent. This was like 3 point something, 4 point something, 5 point something, 6 point something, 7 point something. Expect next year to be 8 point something. So yeah. And the asset has been like twice what their liability is um for the longest while, roughly twice what they have been. So there's that, which is good, on the too much strain on it because of data and something there. And then the dividend payments, as you can see, this is 2019, 2020, 2021, and I say it's also 1, 2, 3, 4, 5. So in 2019 they paid up like this is compared to the stock price. So here some I sit down and go through JC number and I used November 29 or the closest date because that's when they normally pay out the last dividend because they pay it twice a year. You can see right here so is 2 point odd. So it's been so as a percentage of the stock price they paid 53%, 0.53% of stock price, then 2.39, and then yeah, about the two region, and the biggest payout has been for 2023 where they paid almost 2.9% dividend. Which, but is as I say, is a junior market stock. You don't have to wait. As I say, it's a junior market stock, so you don't really expect no major. And I'm say is the percentage of the stock price, not how much dividend they paid. So keep that in mind. Alright, now for market share. So what I did, I just like off the top of my head and based on how it looks, and this was also the list of companies that in college I did choose some project because this I did Fontana analysis. I still never liked it, but I'm just you kind of wanna, however, be proper. So Fontana is in the distribution and medical, and they do sell fixtures. So I just put all three of them together. But you can see Lasco distribution is just killing them with the market share. But Lasco distributes a lot more than just the medical stuff. So really, in the grand scheme of things, if you're going just based off what products, which is the like pharmaceutical things, like which is the core business, are so, then I would have to take out Lasco and probably Fast Rich basically, um, and then get like a better representation of how the market share when it comes to what they sell and their competitors. So they will call like roughly half. I remember that this is just based on what's on the market, not the other pharmacies them where they are all over Jamaica. So there is that. But I'll just keep it as is for sure. Say, oh, even though they are big, they still have bigger competitors. Say now for the relative valuation, and it's a service industry at the end of the day. So you literally have to pool it with all of the service industries, them to get like a better value of it. Alright, so these are all of the service industries near even Regency today. So here it is. At the end of the day, as I'm saying, you can check these on yourself, you know. Um yeah. So the industry average for this is 20.58 for the PE, and the trailing EPS is 0.52, which leads out to a fair value of about $10.70. Alright. And then the industry average for the PB is $3.51. So the book value per share now is 2.2, which teaches a fair value of $7.65. Now the current stock price is $8.13, but the fair value is $9.01. So you're getting it at a roughly 12.8% discount as it stands right now. So you do with that information you will. But yeah, so remember, this is financial advice. It's me. So yeah, they won't be diligent. And that essentially is it for the Fontana analysis. I'll be watching because I'm really interested to see what will happen now. Seeing that the tax break will be down. Yeah. So I'm really interested to see what going to happen. But outside that, the relatively stable junior market company. So yeah. But that's it. As always, guys, love you and catch you in the next video. As always, peace.